Yeah, thank you, Marty. I was on Wall Street for almost 40 years. The first, I would say, 25 years was on the sell side um, with firms like Dean Witter, Chemical Bank, UBS, Deutsche Bank, and then last part of my career, I was chief economist on the buy side with Alliance Bernstein. Um, and I've been doing economic consulting since I left in 2017. And I have my own blog um, because it's a nice way to continue to do my own research and communicate to people that I have been dealing with for, last 20, 30 years. I don't have any
Hey, Joseph,
particular
can you turn your
insight on
volume
what
up a little
happens.
bit?
Talk up a little bit.
Your
Is that
volume,
better?
yeah.
Okay. Again, I don't have any particular insight what happens in the Russia-Ukraine crisis, but let me just give you some thoughts about the economy and focus on two things: inflation and liquidity, because I think that's going to be the big story for investors in 2022 and beyond. From a growth standpoint, I'm probably above expectations, probably growth close to 5%, inflation 5 to 6%, unemployment maybe down to 3.5% this year, and Fed funds at least 2%, given what I'm looking at in inflation. Now, let me just say this. When I was at Alliance Bernstein in 2009, 2010, I made a bet with Kathy Wood, who's now ARK Investors, right? That inflation can never go above 5% again based on how we report it. I'm wrong. Last year it was 7.5% on a CPI, and that's with the shelter component that no longer measures house prices. If you use a shelter component that was used back in the 60s and 70s, CPI inflation was probably 12% last year, which is unbelievable. I never thought we'd ever see something like the 1970s again. Over the last 50 years, we've had broad inflation and narrow inflation in asset prices. And back in, I think, late 1990s, Alan Greenspan asked the question, what are asset price inflations for monetary policy? So I developed a broad price index, okay? A broad price index covers both consumer prices, producer prices, house prices, and stock prices. It was just to try to identify if there was any persistent increase in inflation that the policymakers should be aware of. Now, as you know, we've had recessions in 2000 with dot-com bubble. We had a housing bubble, and none of those were ever identified by the policymakers. So my broad price index, 80 to 85% of it, CPI and PPI inflation. In 2000, it hit a peak of 6%. In 2008, it hit 5.5%. And Fed funds rates were right around 5-6% at that time. In 2021, the broad price index was 12%, and the funds rate was 0. I cannot explain how the Federal Reserve eased policy throughout 2021 with one of the most dramatic increases in inflation we've seen in the post-war period. And they continue to ease policy.
Hey, Joseph, can you turn your volume up?
Sure.
Your volume?
Hold on. Is that better?
Not really. Is that the highest you can go?
Yeah, it's the highest it can go.
Okay, just keep on going then.
Okay. Now, inflation cycles are very uneven. Okay, even if we look at last year, we had CPI of 7.5%, PPI of 12.5%, housing prices close to 20, and stock prices 26%. The thing about inflation cycles, people have to remember, they're uneven on the way up and they're uneven on the way down. Okay, so when policymakers attack inflation, you're going to see declines. Not everything's going to fall uniformly down to 2%. And I don't think they can achieve 2% anytime in the next couple of years, okay? And the reason I say that, there's too much liquidity in the system. So when I was at the Commerce Department years before I started my career, they had this money and financial flows index, which was a huge benefit to me because it was one of the most accurate predictors of business cycles. Money and financial flows consist of private credit, broad money, and liquid assets. And I've been following it for more than 3 decades. It also helps pinpoint excess liquidity situations. like it was in 2000 with private credit, and then in 2008 with housing credit, and it's also today with broad money. You know, broad money last year was up 25%, and now it's up about 15%. You cannot slow down in the inflation cycle when you have too much liquidity or too much money in the system. The Fed has to bring the growth of money down to a rate of growth below nominal GDP. That's going to cause a lot of disruptions in the financial market. Because as I said, inflation cycles don't end evenly. They come down very hard. The fastest adjustments are going to come in asset prices, which is financial ones more than tangible ones. So in my opinion, when the Fed starts tightening monetary policy and then start shrinking the balance sheet, you're going to see Wall Street start complaining about lack of liquidity. And that's going to take down asset prices probably even more than they have already this year, even with the good profit outlook for companies. So what I'm looking at right now is a Federal Reserve that is totally out of sync with what's going on in the economy. And the biggest risk we have right now is policymakers, how they're going to adjust. Now, I heard some Fed speakers say that they only have to do a modest adjustment because inflation expectations are well anchored. Well, you have to keep in mind, inflation expectations follow actual or realized inflation. So persistent inflation will keep increasing inflation expectations to the point where policymakers fall further and further behind. So I don't know how the Fed gets out of this, but keep in mind, if you look at the record from all the inflation cycles we've had, from broad inflation in the 70s to narrow inflation in 2000 and 2008, they've always ended with a bad outcome, recession. I'm not predicting a recession anytime soon, but the Fed's going to have a choice down the road here, either accept more inflation or take a hard landing, because they've let this go on for too long. So I think the economy, given the tight labor markets, will be relatively robust this year and into next year until interest rates get up to a level, at least Fed interest rates up to a rate of 3 to 4%. Now, they may not have to do that much if they shrink the balance sheet a lot and start to lift the yield curve in a very dramatic way. But if you listen to, if you look at the consumer is in great shape, and you're going to see rotation this year, more from the hard goods or the durable goods to more of the service side. A lot of pent-up demand in service sector activities have been delayed because of the pandemic. And we're starting to see a dramatic increase in travel. I heard last weekend was the busiest day at the airports since Thanksgiving. You're going to see a lot of increases in service sector inflation this year, which is going to keep CPI inflation in the 5 to 6% range. From a global standpoint, you know, all central banks around the world are too easy. So as the Fed tightens, you're going to see more tightening by the ECB and the Bank of England, the Bank of Canada. So the thing I would tell people to watch, I know I'm not a monetarist, but watch money supply. Because I know there's an article today in the FT by Martin Wolf about I guess the monetarist dog is back in vogue. But it's one thing that you're going to have to be mindful of as investors, because as the Fed shrinks liquidity in the system, it's going to come out of the financial markets before it comes out of the real economy. Let me just take some questions right there.
So who gets hurt by the current agenda? Because I mean, on the one hand, we have this, you know, inflationary period, and depending on what measure, we either have 7% or 12% inflation, as you just said, right? You've got, but you still have a workforce where people are dropping out of it because of retirement, et cetera. So if you're young, you find good jobs, right? There's good paying jobs out there, which are kind of offsetting the inflation. So are the people that are getting hurt by this, are they people on fixed income, or you know, what are the levers that are being pushed here in terms of the people who are getting the most, you know, negative feedback versus positive feedback?
Well, for so far, companies have had good pricing power over wage growth. But I think the tight labor markets are going to keep putting an upward pressure on wages and start to hurt profit margins. From a consumer standpoint, certainly, I mean, every consumer is getting hurt right now because average wage growth was less than inflation last year. And keep in mind, when you don't include house prices and CPI, it takes a lot more debt to buy a house today than it did before. So consumers get hurt with this over time. And again, the Fed has always argued. I remember a couple of weeks ago, one of the Fed governors said they don't want to do an abrupt tightening in monetary policy because it destabilizes the economy. That's wrong. It's the removal of inflation that destabilizes the economy. And it's because it's very uneven on the way up. I mean, look, last year, used car prices and new car prices were up 30, 40%. The CPI was 7. So last year, the Bureau of Labor Statistics said shelter prices were up 3%, yet housing prices were up 20. So keep in mind that everything is uneven. And when it comes to the reversal, so things that go up the fastest are going to fall the fastest. So yeah, people get hurt. Companies are getting hurt because they're getting squeezed as well. A lot of companies can't pass along down the road some of these cost increases. You know, producer prices for intermediate materials, all right? This is one of the best leading indicators of finished good inflation at the consumer level. That rose a record 23% last year. That's
So
even higher than the 70s.
People talk a lot about supply chain, right? But to me, it's really not supply chain as much as it is the cost of energy. I mean, sure, maybe some production has slowed down in China, but you know, if you're sourcing correctly, you should be able to source in, you know, Vietnam or Taiwan or wherever, right? You should be able to source other places. But really, the cost of energy has gone through the roof, and I don't think anybody has ever factored into this, you know, global supply chain, the cost of an additional mile of having to transport something on a ship or via a truck. When your cost of gasoline, I think it's going to be $4 in the next couple of weeks, probably for the average gallon, right? So when your cost doubles of fuel, like transportation fuel, I mean, to me, that's more impactful than supply chain. But do you have any thoughts or analysis on that, or?
Well, I think you make a good point. There's no question that the increase in demand has lifted energy prices across the board, and that's a big impact on household budgets as well as corporations. But I think one thing people forget to realize is that the 1970 inflation cycle started with supply shortages. It was a commodity shortage and a food shortage in the early 70s, and then you had the oil embargo. So inflation cycles start on the supply side and end up on the demand side with monetary policy and fiscal policy remaining too stimulative. And keep in mind that in the 1970s, policymakers looked at a negative trade-off between inflation and unemployment. In 2022, they're going to look at the negative trade-off between inflation and financial assets and financial market instability. That's a new trade-off for them, and I don't know how they're going to deal with it. In my opinion, there's no Volcker type in this current generation of policymakers. They're all more on the dovish side, in my opinion. So I think you're going to end up with more inflation.
But from my worldview, you know, so you're talking about, you know, financial assets, but the reality is that there is kind of this lattice of debt and credit at a very low rate. And as those rates go up, there's going to be all kinds of exposure, right? It's the old saying about when the tide goes out, you know, doesn't have any shorts on, right? So, you know, do you have any thoughts on that? I mean, obviously there's this whole world of, I mean, even if you look at the Bitcoin hodlers, right? Those guys have borrowed like crazy to buy Bitcoin. People who are bought real estate based and gone heavily into debt to buy real estate, you know, there's this whole wave of people who are very interest rate sensitive. And any thoughts on that and what that wave looks like? Yeah. And also, if you have any thoughts on safe harbors, that'd be great.
Well, keep in mind, I mean, I think one of the lessons we learned from the housing crisis was too many buyers had adjustable rate mortgages. And therefore, when rates went up, they got hit hard, and many of them couldn't even refinance. So I haven't looked lately at how the debt between fixed and adjustable um, debt out there, but there's no question, as interest rates go up, you're going to see companies start complaining that non-labor, non-commodity price costs are going to be an important part of their overall cost structure. I think you have a good ways to go on that because corporate debt is still relatively cheap. But 100, 200 basis point cost in financing is going to add to pressure on profit margins down the road. So you're right. Once when you leave rates so low for so long, you create a lot of disturbances that you don't really realize until rates start rising, and that's the problem with the policymakers. They just threw the kitchen sink at everything back in 2020, and now we're going to see the aftershocks of this.
Right. So we've been an alternative network for many years. I mean, we've invested in every alternative asset under the sun, right? I mean, after 2008, so many people jumped into secondaries, for example. That was huge. And then, you had this explosion in private debt markets, right? Because all the banks had to pull back on their lending, and private lenders came in and took the space, right? So any thoughts on the impact on all of these different alternative segments, and which will be most sensitive? Like, what's going to happen to venture capital, because a lot of tech is based on a high amount of leverage, zero debt, right? And what's going to happen to private equity, and what's going to happen to the hedge funds, and what's a safe hedge fund space to bet in? I mean, is value going to come back in? Because in reality, like, value hedge funds have been a failure for 14 years now, because anybody, if you saw somebody who might have some difficulties, they can always borrow their way out of their difficulties, right? Unless they're in the most extreme cases. So any thoughts on that?
Well, keep in mind that none of all those asset classes you talked about have never been stress tests for high inflation. I mean, we haven't had high inflation for a long period of time. So I think you gotta rethink all your strategies in this environment, because it's a totally different investment climate. And there's not too many asset classes that do well, based on my experience, in high inflation environments. Okay, you have to be mindful of that. Anything that's these companies, they're not making money, they're in trouble. The people that have our companies have a lot of debt, they're vulnerable as well.
So you talk about like the Fed toolkit and the government toolkit. I mean, we go back to the 70s when there was gasoline went from like 20 cents to $1, right? And so that was a 5x on energy pricing. And you had all kinds of other expenses come in that never existed before. So, I think Nixon tried price controls for a while, right?
Yeah, I was actually on the President Carter's Wage and Price Council, where we tried to put in wage and price guidelines for companies. And I will tell you something. I've never seen so many smart people circumvent so many rules by the government. So they don't work.
Right, that's the point I'm trying to raise. So like, what if you see, if you have a toolkit, what do you see in that toolkit? I mean, here's a great example of a kind of unintended consequence, right? So one of the great things about Silicon Valley is that they give people these enormous stock option grants or stock, et cetera. But what happens when those stocks, decline massively? I mean, you see the crackdown in China, right? That's happened, and all those companies have declined dramatically in value. Facebook just lost 25% of their value. So people who are using, their stock for investment, as collateral, all kinds of things are going to happen. And any thoughts on that? I mean, because that's been a pretty big incentive in the world of compensation for, years before 2008, but much bigger since 2008.
Well, I think if you go back to late 1990s, you're right. When stock options really took off, um, people were being compensated with stock options, and it never showed up in the wage data until the government was able to measure it. Um, and people use or companies use the stock to attract workers, maintain workers, and workers use that as a bank, right? And just like they did their house. Keep in mind what happened after that craze. The equity market went down for 3 consecutive years. Um, and a lot of people left these companies because they thought they were getting paid, and they were ended up not getting paid half as much as they thought they were getting paid. Um, so there could be a lot of workplace disruption as well if the equity market goes down. So that's why I'm saying the trade-off today is between inflation and financial stability, and we've never been in this environment before. Um, I mean, the equity market went nowhere in the 70s, as you all know. But the inflation created, remember, inflation creates liquidity, income, and wealth. And the reversal gives you losses in all three. And so how long this goes on, there's going to be certain winners on the way up, and there's going to be big losers on the way down. To me, what are the assets, or where's the inflation the greatest and the most imbalanced? To me, equities are very high. The market valuation of domestic equities to GDP is the highest ever. The housing values relative to income and other assets is one of the highest ever. So those to me are the stress points in the system. Certainly PPI and CPI inflation is high, but nothing like that.
Yeah, so that's really interesting. I mean, so you're talking about ratios, but I mean, so we know that when there's typically a decline in financial markets, there's also bloodletting on Wall Street, right? And then there's, more job decline. Again, I can't talk about any kind of job decline because there's such a massive wave of people retiring. It seems like they're going to be taking a big hit. People on fixed income are going to take a really big hit, and people who are heavily invested in the financial markets if the markets decline, right? So inflation crushes fixed income, right? And then you have the rest. So, it's kind of a dilemma, but it seems like the Fed's kind of painted itself into a corner there, right?
Yeah, they created this pickle, and now I don't know how they get out of it. I mean, you can talk about having, it doesn't make any sense to me to have a 2% inflation target, because you're going to hit it more by luck than by design. The only reason they adopted a 2% inflation is because when they moved to a 2% inflation target, inflation was a little bit below it. And so they didn't want to say that they were trying to promote inflation in the system. The Fed has enormous task ahead of them. Certainly fiscal policy can help them if they don't continue to increase spending. I mean, what Congress did last year with the huge spending thing, that put a lot of demand in the system. But remember, people forget about the 1975 tax cut was one of the biggest tax cuts in history at that time. And it was followed up by additional spending increases in 77, 78, and another tax cut in 78 by the federal government. So, it works both ways. Monetary and fiscal policy can drive inflation expectations and make inflation pretty persistent. The longer this goes on, I mean, the record's pretty clear. The adjustment is going to be more wrenching than it is if you do it quickly.
There were big cuts in military back in the 70s too.
Yeah.
And I think Biden just asked for $700 billion for the military.
Well, all the dollars matter. I mean, we have a budget deficit in the trillions. We have a huge federal debt. So it's going to increase our costs of borrowing as well.
Hey, Joseph, can you talk a little bit about your practice and what you do? I mean, I know a lot of economists, a lot of them, they put out research like you do, and then they do a lot of special projects. Do you do special projects? And, where are you in terms of, what's happening in the future? Because it seems like there's a big need for guidance for people on, you know, how to handle this era that we are in and going into further. Because I unless we, you know, decide to start drilling oil again and opening pipelines again, energy is going to stay high. And unless we start tariffing, you know, goods, we're going to continue to have deficits with countries.
Well,
So
one thing, what I can offer your audience is that I will continue to monitor two things: the broad price index and my money and financial flows index that I publish now for like 20 some years, because it'll tell me two things: how successful the Fed is reducing liquidity and how quickly, and how bad the inflation pressures are. So it will continue to pop up on my blogs. I'm happy to take calls from any of your clients to discuss the situation. I work with a couple firms right now, and one firm out of Wisconsin, a couple out of New York. But again, it's you know, it's I'm not employed by a firm directly, so I'm doing this on my own.
you know what's interesting, you know, one thing that's interesting is that, you know, you talk about like state pensions and things like that. What's going to be the impact? I mean, if financial assets decline and they have actuarial targets of, you know, 7% on their defined, you know, benefits programs, and if there's a decline of, you know, I guess we're in a stock market correction now, aren't we? Right? So
Yeah, mild, very mild.
right, if we go into a recession, that's going to impact those pension funds as well, right? So, you know, any thoughts on that? Again, that gets back to the fixed income retiree question, but I mean, it also deals with all kinds of other, I mean, that has a tremendous ripple effect, right? The way the pension funds invest, the way they pay out, you know, et cetera. Any thoughts?
Well, look, in my opinion, this is going to be a washout. Okay, you're going to have to make fixed investments start to be valuable for people again. Right now, the interest rates are so low, they're not really valuable. So I think you're going to have a rebalancing down the road because, you know, money was free for such a long time. Everyone gravitated toward the equity side because the returns were so enormous. So I think once it shakes out, interest rates will be higher, equity prices will, and the multiples will come down to more reasonable levels, and then you'll be able to move on. Let me just leave you with one positive thought, okay? Because again, if you go back and look, someone sent me this 20 years ago. The low of this year to the high of the next year in the S&P or Dow Jones, the average return from the second year of a presidential term to the high of the next year, and this goes back 110 years, has been 35%. So something's going to happen to drive markets down. And then I remember what Felix Zulauf said in Barron's in late December. He said the Fed's going to drain the liquidity system and get so scared they're going to turn liquidity on again. And
it's happened every time, right?
Yeah,
Since 2008.
And I respect him. He's one of the brightest investors I've ever followed over the years, and I can see that because I said the tension this year is between inflation and financial stability. So I think at some point, if this happens, unfold very disruptively, the Fed's going to face a decision to turn it back on again. As you said, they've done it many times in the past.
Well, the issue this time really, though, is capacity. What's their capacity to do that and to put more liquidity out there? And it's fairly constrained. You know, that's the issue right now. We're going to, you know, if we do anything with Ukraine and we get involved in a major way, if we pass some more spending bills, we're going to really not have the ability, especially considering the impact inflation will have on our deficit.
That's a very good point. But let me just say this. I never thought in my lifetime I would see a Fed balance sheet of almost 9 trillion.
We're all in that boat.
Yeah.
We're all sitting there.
Yeah, I understand that. And so, you know, what if they went from 4 to 8, what prevents them from going to 8 to 12 if the shit hits the fan again? Excuse me, but You
Well,
know,
somebody's got to buy it, right?
yeah, yeah,
And I don't know who the buyers are going to be. I mean,
you're right. You're right. Well, the Fed has been a buyer. Central banks have been buyers, right? I think
right.
someone told me they own, I don't know how many trillions of government bonds in the world right now.
Hey,
You're right.
Joseph, I just want to spitball here one last, circumstance, right? So I was reading an article yesterday, it says like there's actually more variable rate mortgages out there now than there were before 2008. And that, there's a lot of people that have, balloon payments and things like that. And something that's real ironic is that all the people that were foreclosed on and went bankrupt in 2008, that came off their records in 2017, 2018, so they went and bought houses again, right? So if there's like a mass default, if there's gonna be a lot of defaults on mortgages again, I think the government's kind of painted into a corner on what they can do too, right? I don't think that the solution of 2008 will be politically plausible in 2022, right? I mean, it's like a fool me once sort of thing, right? Where it seems like it's government's bad behavior by, creating all this easy money, et cetera. People shouldn't have to take the impact of getting foreclosed on as they were in, there was millions of foreclosures in 2000, following 2008, right? So I think there's another political issue that's gonna happen, as a result of this, because they don't talk about it, but the real estate is just as bad now as it was in 2008. So any thoughts on that?
Well, if the government can lend to companies that were almost bankrupt in 2020, I think that what you think the rules are of the past are going to be different in the future. I think if millions and millions of households are going to face default, there's going to be a government program there. Or what happens is those politicians that oppose it just get voted out of office. I just think we've changed the floor on what we will do from a government standpoint.
Right, I mean, we've had MMT because of COVID, right? So they'll resort to it again, but I'm not sure what that's gonna look like, so.
No, I'm not sure about what COVID, but I'm just saying the precedent that the Federal Reserve did with all their lending programs of last year,
Yes,
that they can expand that to a bigger audience in the future.
I agree with you, yeah, absolutely. So listen, Joseph, can you do me a favor? Can you go on the chat and just type in how people can reach you?
Oh, sure.
It's a great presentation. Also, I know people are always looking for special projects. To me, as you just said, all these alternative asset classes that people have invested in for the last 40 years have not been tested by high inflation.
Yeah, you're right.
And I mean, when you think about venture capital, which typically does pretty awesome after recessions, right? That's when they make their best investments because valuations are pushed down so much. They really have not been through an inflationary period, a prolonged inflationary period. So it's really interesting to see. And I think anybody who's looking at their portfolios needs to say, well, what does it all mean, right? So it's really fascinating times.
If you think economists are confused right now, just think about investors who never face it.